Hi everyone, welcome back to the channel. So, as of now, we have discussed question number 1 to 20, and today we will be starting with question number 21 onwards. So, let's start. So, the question number 21 is about the bailout. So, what is a bailout? And if somebody asks you, how does a bailout affect the three statements? So first of all, you need to understand what a bailout is. So bailout is actually uh, it actually refers to a provision of financial assistance to a corporation, organization, or government that is facing significant financial distress in bankruptcy. And the primary purpose of bailout is to prevent the entity from collapsing, which could have serious repercussions for the broader economy. So that's bailout, the definition of bailout. So you first, if you are getting this bailout, some sort of help from the government, so you first need to confirm whether it's in debt or in equity. So if somebody is helping you, maybe they are giving you a debt at a lesser interest rate, or they are actually investing in the equity of the organization, or there is a combination. So the most common scenarios are the equity investment from the government. So equity investment, what the government does is the government takes in part ownership in the business, and then the government helps because debt and equity, because the equity holder has more risk, and holding an equity in the organization actually gives a greater returns also if everything goes well. But a debt holder is only limited to a return of interest only. So if you are helping out somebody, if you have an opportunity to bail out somebody, I would, not recommend something, but the government does invest in the equity of the organization. That way, when the company starts up and running, so the return on the equity is much more greater than the interest component of the debt. So let's see how it actually impacts the three statements. So the income statement, there is no change because there is the money when the help or in the form of money is received by the organization, they will not run it through the income statement. They will actually run it through the cash flow statement. So the financing component will go up by 100%, $100. Assuming a hypothetical figure, $100. So the government invested $100 in the financing. It could be equity financing or debt financing, and the cash will be going up. As of now, we have not spent the money, so the cash will go up. Like previously we have discussed, how does the how does it works? Just let me start my let me just give me a moment. I will be sharing my Excel in a moment. Hmm. So, the cash flow from operations, the cash flow from investing, and the cash flow from financing. We have discussed about those things. And all these, when added up, they make the changes in the. Now my Excel is visible. So, cash flow from operations, investing, and financing. When we add that, the total change is shown here. So if from financing they are receiving $100 of debt, so this is going to increase the cash. And we know that the closing cash is linked to the balance sheet. So the closing cash will be linked to the balance sheet. This means that there will be $100 of cash in the organization, inside the organization. And how do they use that cash? It's uh, their decision. So we have received $100 of cash, and the cash will go up, asset side will go up, and the shareholders' equity will also go up. So because here we have not, we are actually having a check of $100 minus, because in the asset side has gone up. But where will we show the $100 of bailout amount, which we have raised from the help of government as a debt? So this will be shown here in the retained earnings section, shareholders equity section, uh, and $100 of debt which we have raised through bailout. So we will account it here on the balance sheet. So I hope this is clear. And in recent times, you might have heard about the financial crisis of 2008. If you are young, if you are a Generation Z, so you might have heard of 2008 financial crisis, where the 2008 financial crisis because of real estate. That's a different story. And when that financial crisis hit the market, other sectors were also disrupted, and automotive industry bailout, and the debt, and the real estate industry bailouts were given by the government. And in the recent times, you all have witnessed the COVID-19 pandemic, and the the characteristics of a bailout are actually the financial assistance provided and stabilization, with an aim of stabilization and government intervention. So the characteristics of bailout are those. And why does the government does a bailout is because it actually helps the, there are few sectors which cannot be filled, like banking sector, big sectors. Uh, so they are too good to fail, and they also are important for the economic stability and job prevention, because if sector one sector fails, then the job security and the job prevention of that sector actually gets impacted. And also moral hazards. So later on, the challenges and criticism, the challenges which are tied to the bailout are, in the times of the crisis, government does help, but later on, it's challenging for the taxpayer. So later on, you might have seen that there was quantitative easing one, two, three during the COVID-19 crisis, but later on, the government increased the taxes and the interest rates increased, because to recover what has actually happened. So the after effects are actually very uh, difficult, not difficult, but it was the necessity of the hour at that time. So let's not talk about a lot about this. So let's move to the next question. I hope bailout is clear to you now. Let's move to the next question. So if okay, so it's an interesting question. Walk me through $100 write down of debt. So write down of debt as in owed debt, debt liability on a company's balance sheet, and how it affects the C statement. So writing down of debt which was owed by the company, so they actually have to write it down. And writing down of a debt, or removing a debt liability from the company's balance sheet. Uh, See, this $100 of written down of debt will be in the pre-tax income, and the pre-tax income will go up by $100. And assuming a 40% tax rate, net income is up by 60. Let me show you an example first. Let me just show you an example first before I earlier I actually had found an example which was related to this thing. So Pfizer actually did uh, Pfizer actually Let me just 33.5 the amount. Yes. Pfizer actually uh, did a debt extinguishment of debt in 2023. Pfizer actually, the question was written off. The Pfizer actually written off debt of 33.5 million exchange. They have recognized it as a debt loss on extinguishment of debt, 33.5 millions. So it's in the note section of the company. So this 33.5 amount is also, see, here in this, what we were talking about, the pre-tax income, 33.5 in year 2023. So they have shown it as a loss of 33.5. If it was a gain, they would have considered it as a gain, and this is a loss. So extinguisher of debt, they are saying that they had a loss of 33.5 on the debt. And you know that this has impacted the income statement, the net income, and this has impacted on further on. And the other two financial statements also. So let's look at the cash flow first. So here there is uh, this component, non-cash extinguishment of debt. So pay attention. Now the earlier amount was 33.5, which you actually have searched, and this is 17.4. This is 17.4 only. So they have added it back here because this is a non-cash expense. So they have added it back 17.4. Now, now if you look at the other numbers, now understand this thing. The number should be 33.5, and this 17.4 is written here. They have claimed 17.4 here, but the other amounts they have clubbed those numbers in other line items. So if I add 17.4, which is which we have recorded already clearly, and I add 24.3 from amortization of debt issuance cost. So the nature, like in the first video, I have told you the nature, you need to understand the nature of the listings. So 33.5, we actually have to calculate 33.5. So these two numbers are clubbed together. Some of the rest of the amount is clubbed here. 24.3, 41.7, and in other liabilities. If I subtract 8.4 out of it, so 33.3, and we actually have to account for 33.5. And this difference, point 0.2, it might be clubbed in somewhere else, somewhere in these line items only. So when an accountant's work finishes, an analyst's work starts. So like I've told you previously also, pay attention and pay attention to detail. So this is how you account for that. The difference should be here. The you should be accountable. So the difference should be clear, and that's why most of the analysts actually rebalance their financials. This is important to understand these things. So 17.4 you have here and 24.3. These are representing the same numbers, but something to out of something else is clubbed in here, and some and the other amount is in the other liabilities. So this is how you calculate these things. So after income statement, we are on the cash flow statement and the balance sheet component here. The balance sheet component, let me see if they have written something. Deferred tax agreement. So basically, you have gotten the gist of how we actually look into the financials. So this actually Before the lecture, I actually went through the financials to find an example so that it's better for you guys to understand these things. So let's move to next question now. This is the next question. So, okay, let me just complete this question number 22 first. So we have seen the impact of income statement. We have seen the impact of cash flow. Now on the balance sheet, the cash is written down by 40 if the bailout is 100. So I'm sure that uh, if you have watched the previous lectures, you will be able to figure out how the balance sheet is impacted. The cash will be go down by 40, so assets are down by 40, and the debt will be down by 100. But the shareholders' equity will be up by 60 because of the pre-tax income, because of the net income. So minus 100 plus 40 is minus 40, and cash is down by 40. So then the balance sheet balances. All right. So I hope this is clear. So let's move to question number 23. And question number 23 is about cash collection from a customer and not recorded as revenue. So uh, previously, when we were discussing about Apple, we have seen that there was a component of deferred revenue. So this is what the question is talking about. So deferred revenue component. So when would a company collect cash from a customer and not record his revenue? So these are the few of the examples where web-based subscription company, a web-based subscription software company, cell phone carriers like if you are having using Airtel, Jio, or any other cell phone carrier, then you pay the annual subscription cost, and every month the services are delivered to you. So every month, unless until the company actually delivers the services to you, so the company do not recognize it as a revenue. Magazine publishers that sell subscription. So if you are giving them money for a longer period of time, but the services are being delivered to you slowly, so until they deliver you to service, they do not recognize it as an revenue. And companies, so the explanation is companies that agree to service in the future often collect cash upfront to ensure stability revenue. Okay, this actually is a part of ARR, which we have not discussed, annual recurring revenue. Annual recurring revenue. So companies, if you see that tech companies usually, uh, let me see if I have an example there. Uh, so tech companies usually or any software company, let me see. So they actually report out their ARR numbers. Yes, ARR, no. So no, not in that. So ARR basically is annual recurring revenue. So I have all the money. I have the money which I'll collect will be a part of deferred revenue. And out of deferred revenue every year, how much, I mean, for how long can I pay out of out of this money? So for how many years do I have to, how many years can I pay? That depends on the contract also. So because we are only working on the question and answers, we will do that part later on. That's way too much interesting and lengthy. So the business model of the organization actually decides all these things. Uh, there are smaller cycles, bigger cycles. So the cash is collected, but not recorded as revenue. These are the examples. And for the accounting, as per the rules of accounting, you only record revenue when it is actually performed the services, or the company would not record anything as revenue right away, and that's the rule. Revenue is only recorded when it is earned. So as of now, they have not earned the revenue. The money is there, but they have not delivered the services. So yes, I hope this is clear. So let's move to next question. So question number 24, if cash is collected and not recorded as a revenue, but happens to it, and it is linked to the previous question, so it goes into the deferred revenue balance on the balance sheet item under liabilities. Over time, the services are performed, the deferred revenue becomes a real revenue on the income statement, and deferred revenue balances decreases. But this is just a one-time event, but the company still keeps on working and the deferred revenue balance also keeps on increasing. And there are a lot of metrics when you study the financials of the company, you look at those numbers. And for that, the listings are very important to understand. And every company has different listings and the line items, and those depends on the business model of the company. A quick cash company will not have a deferred revenue balance. Like yesterday, we talked about McDonald's. So McDonald's won't be needing deferred revenue balance because when we go to a joint McDonald's restaurant, we pay upfront, we get the services, and that's it. We are not doing a contract of uh, long-term contracts. So and paying them upfront so that they can slowly pay us services, and it will be it. I mean, thinking about it, this will not be surprising if. I mean, McDonald's does or not. I'm not sure, but this will not be surprising if they do something new in their business model. The corporations, if some corporation is actually hiring McDonald's, or you might have seen in your offices or colleges, there are coffee vending machines. So those are long-term contracts or leases and all. Those are long-term contracts. It depends on the business model of the organization. So I hope this is clear and this does make sense. And so let's move to the next question. So difference between account receivable and deferred revenue. This is linked to the other two questions only. So the difference between account receivable and deferred revenues. Account receivable, we know that we have not, I mean, we have not collected receivables and payables. Don't get confused. So account receivable has not yet been collected from the customer. Receivables. We were to receive, but we how much we have to receive? We will recognize we will write it down on the balance sheet how much we have to receive. Whereas in deferred revenue, the money is already in there, but we have not recognized it in the as a part of revenue. So account receivable represent how much revenue the company is waiting on. The deferred revenue represent how much they have already collected, but they have not recorded as revenue because they have not delivered the service. All right, this is clear. I think this cannot be more clear. I mean, there is no better explanation than this. So, okay, next question. Let's move to next question. And these are actually theoretical questions, majorly. The Excel questions we have done, the basic Excel questions where we actually linked everything and all the impact of change in one item and the impact on other items. So income statement, balance sheet, and cash flow, how they are linked together. This actually shows that previously what we have discussed. So I would, if you are new to the channel, I would recommend you to just go through, take some time. Uh, if you are already expert in finance, even then I will recommend you to just go through those videos, and I mean maybe that will give you a new perspective onto something. Uh, if it helps you in any way, my all my efforts will be successful then. So not wasting more time. So let's go to question number 26. So how long does it usually take for a company to collect its account receivable balance? Account receivable balance, they are actually the standard industry standards are 30 to 60 days. But companies selling high-end items and smaller items, so it depends. So receivable balance, if I had to receive some money from someone, so like we have discussed, it depends on the business model of the company. And those companies which have similar business models, uh, uh, similar business models, the industry standard for those companies is 30 to 60 days of range. It depends. And Business cycle also is dependent on that, how early, how much time it takes to process your inventory, accounts payable to your creditors, then and receiving amount from the customers. So it takes 30 to 60 days. And exemption, like exception, if you talk about exceptions, those quick cash businesses like Domino's or McDonald's, where you pay upfront. If I am supplying dough or wheat to or other raw material to Domino's, then I am their supplier. But Domino's is a cash-rich company because they are getting money upfront from the customer. You pay, you get the service, and you go home. That's it. So if I am a supplier to Domino's, then I will get my money upfront or within a few days. But the cycle, business cycle will be smaller. And if we are talking about the high-end items, so high-end items like car sale, car. If you are selling a Mercedes, so Mercedes, you will the Mercedes will be going to a shop. A dealer will be showing Mercedes, and it will sell when it will sell, and how better the sales and the marketing people are working onto that. And I mean, higher accounts receivable are for high end items, and lower for lower transaction value companies. Like the example is Mercedes for high end, and for lower and smaller low transaction value companies, Domino's. Just remember these kind of things and try to think from the practical perspective majorly. Right. So let's move to next question. Question number 27. So difference between cash based and accrual based account. So this is actually interesting. So cash based accounting, if you the cash based accounting actually recognizes revenue and expenses only when they are received or paid, and it actually focuses on the actual cash flow, and it's more straightforward. But accrual based accounting recognizes revenue when it is earned and expenses when they are incurred, regardless of cash transactions. So accrual is the previously we discussed about the deferred revenue. When we will pay the when we will deliver the service, then only we will uh, recognize it as a revenue. So that's a case of accrual accounting. So provides accurate and accurate picture. Accrual accounting actually provides a more accurate picture of the company's financial position by matching income and expenses of that specific period. But the thing is that cash basis is simpler and focuses on cash flow, while accrual basis provided a more comprehensive view of the financial performance by recognizing transaction when they are occurring. So here the explanation is that cash-based accounting recognize revenue and expense when the cash is actually received or paid out. Accrual accounting recognize revenue when collection is reasonably certain. That is for the customer has ordered the product and recognize expense when they are incurred rather than when they are paid out in cash. So most large companies use accrual accounting because paying with credit cards and line of credit is so prevalent these days. And small companies use cash-based accounting. So bigger companies use accrual, smaller companies use cash based, and also government or the obligation, the taxes, the authorities actually prefer accrual accounting. This is also an important component, and majorly companies which are listed on the SEC or stock exchanges of your country. If you are Indian, so NSE, BSE. If you are from US, it's SEC, Securities and Exchange Commission. So accrual accounting actually is preferred by the companies, and it's a standardized norm throughout the companies. And cash-based accounting is done by smaller businesses where there is no obligation to report out their financials. So yeah, that's pretty much it. So if you ever find any doubts, you can always uh, mention it in the comment section. I will be happy to answer those doubts. Let's move to next question. So the question here is, let's say customer pays for a television with credit card. And what would it look like under cash based and accrual based? So if somebody is paying using a credit card, let's see how it will look under accrual accounting first. It will show up a revenue right away because it would show up as a revenue right away, but instead of appearing in cash on the balance sheet, it would go to account receivable at first because they have paid it using a credit card, not cash. Then once the cash is actually deposited in the company's bank account, it will turn into cash. And why this? Because we know that credit card companies don't, yeah, if you are using a credit card, then even though you have paid the amount upfront, but the credit card company takes some time, 30 days basically, 30 days or at the end of the month, they uh, they submit the cash to the company. So until until then they will receive the amount in the account receivable, and after that they will turn it into cash. But on under accrual based accounting, the revenue will not show up until the company charges the customer's credit card, receive authorization, and deposit the fund in the bank account, at which point it would show up as both revenue on the income statement and cash on the balance sheet. So unless until the credit card is being used, after using the credit card, the company will recognize it in the income statement also and cash on the balance sheet also. So this is the difference in the accrual, cash and accrual based accounting. So for smaller businesses, this one is cash based accounting for smaller businesses, and accrual based accounting is for larger businesses. So it might be confusing for cash based accounting. So they will receive the revenue upfront, but in the in the balance sheet, they will also receive the revenue. The cash will be received in the balance sheet also in the income statement also. All right, so let's move to next question, 29. So, okay, so when to capitalize and when to expense a purchase? This is interesting question. And for that, you need to understand that uh, if if an asset has a useful life of more than 1 year, then we will capitalize it. And if we are capitalize something, we can depreciate the amount, and we can add it onto our balance sheet, like factories and land. But those expenses which are uh, those are those purchases which cannot be counted as an asset, we will expense it out straight away. Like employee salaries, we will expense it out. Cost of goods sold, we will expense it out. So this is basically this is the basic difference to capitalize or expense. If the useful life is more than 1 year, we will capitalize it. If the useful life is less than 1 year, we will expense it out. More than 1 year, capitalize, less than 1 year, expense. And something we will only consider something as an asset if in future or it will help us to earn money, then something is considered as an asset, or else we cannot consider it as an asset. Assets, the basic nature of an asset is they will help us to earn money. That's it. I hope this actually clears this question. So let's move to next question. Uh, okay, so gap to non-gap. Why do companies report gap numbers and non-gap numbers in their earnings? So gap numbers are those numbers which are reported by, I mean, you know, generally accepted accounting principles. Those are the basic definition of gap. So if I'm preparing my financials according to the government regulations, then I will be using the gap. But the government gives me exceptions where I can reduce those numbers or take exceptions. Take so that taking the exceptions actually reduces my income. So GAAP numbers are lesser than the non-GAAP numbers. So there are few adjustments that can be done to report out GAAP to non-GAAP numbers. So as per the, if I am making the my financials as per the government regulations or the taxing authorities regulations, then I will report out a gap. But the government gives us a lot of benefits also to the business owners. So the gap numbers and the no, but if I am an investor, I would want to know what are the organic numbers if uh, the company did not had any, I mean, losses or any exceptions. Without exceptions, how much the organic numbers or the core from the core business model, how much the organization has earned. So let's take an example. So I have actually found, actually before that, before starting the lecture, I actually looked into Intel Corporation's financials. They have reported the GAAP to non-GAAP numbers, and I just want you to give show you, just give a rough idea of what are the exceptions. So Intel, you can find these numbers on the SEC. So gross profit they have reported out as 3542 in the recent quarter. And the non-GAAP numbers are the gross profit is 3814. The GAAP numbers will be reported in the income statement also 3542. So the GAAP numbers will be reported in the income statement also 3542. But there were two exceptions this quarter. Acquisition related adjustments. So the GAAP had two exceptions. One acquisition related exceptions, acquisition related adjustments, and share based compensation. So for these are the two of these are the I mean these are among the two other adjustments which are used to convert GAAP numbers to non-GAAP numbers. Other exceptions are also restructuring and other charges, one-time expenses in nature. These are majorly one-time expenses or one-time in nature. So these were exceptions which were taken, and they are not reoccurring in nature, but one time in nature. So getting back to the question, let's talk about the question. What the explanation saying. So these days, many companies have non-cash charges such as amortization of intangible, stock-based compensation, and deferred revenue write down in their income statement. As a result, some argue that income statement under GAAP no longer reflect how profitable the company truly are. Non-GAAP earnings are almost always higher because these expenses are excluded. Okay, so like I told you, if there is a company and I want to know, so the gap numbers, okay, I understand the gap numbers will be reported by the company. But if I want to know how much the company would have earned or how much the company did actually earned from its core business activities, core operating activities. So I will look in the non-GAAP numbers, and that's why the non-GAAP numbers are more important to an investor than the gap numbers, because these non-gap numbers actually include the one-time exceptions taken by the organization also. So because those were one-time exceptions, so I can understand that, okay, the next time those exceptions will not be there, but something else will be there. But I will, as an investor, I want to know the one-time exceptions which are important for the organization. So these non-gap numbers are actually non-GAAP numbers are actually more important for the investor. And the government gives preference to GAAP numbers. So I just try to process these things. Just if you have any doubts, just post it in the comments. And I will conclude today's session with this. And if you have learned something of value, kindly subscribe to my channel, and please wait for the next lecture. I will try to make the other four questions as quickly as possible and with a better, I mean, with the best explanation. Yeah, sure. Thank you. Thank you. Thank you.